No sign of an end to the fighting in Libya, and that means trouble for the country's oil industry. As Africa's third largest producer, normal output is 1.6 million barrels of oil a day. That's dropped by 2/3 since the uprising against Colonel Gaddafi began, and that's costing the government in Tripoli $100 million a day in revenue. 80% of the country's oil sits in the Sirte Basin and is right on the battle line between pro and anti-Gaddafi forces. The El Bouri oil field off Libya's western coast is the largest producing oil field, and output there's been hit. The Al Hamra fields and the isolated Merzouq Basin in the south are still producing, but key foreign workers have left and they make up 10% of the oil industry workforce. Once produced, crude oil is piped to the main terminal ports for export. There are 6 terminals, 5 in the east, mostly in rebel hands. Brega has been bombed by the Libyan Air Force as pro-Gaddafi soldiers have been trying to recapture the port. It's not working at the moment. The facility at Zu 18 was bombed last week. Ras Lanuf isn't working after fierce fighting around there, and there's been fierce fighting around Zawiya, but it's still operating.
There have not been damages to the oil installation, so there is no reason why, if the conflict in Libya ends relatively swiftly, there is no reason why Libya should not resume production. And then, whatever the issue of the conflict, any camp will have interest to increase oil production to get revenues from oil.
Here's the other problem. The fighting means companies are reluctant to send ships into Libyan ports, and even if they do, it's not clear who they should pay, the Gaddafi regime or the rebels. Both sides in the fighting say they will not target oil installations, but that hasn't been enough to protect the industry. According to the latest figures, Italy is the biggest market for Libyan oil, followed by Germany and France. China takes 10%. Europe sucks in more than 2/3 of the output. Losing that supply forces them to look elsewhere, and that drives up prices across the board, making fuel much more expensive for everyone.
That is an anxiety to central bankers who are trying to manage and control inflation, so their reaction to that will be to raise interest rates. The knock-on effect of that could be to throttle down, to choke off what is still a very fragile recovery from the recession.
The fighting in Libya has already pushed the oil price to a 2.5-year high. Fear of unrest across the region could push it even higher. The effects of the uprising now being felt far beyond Libya's borders. Alan Fisher, Al Jazeera.